Hi, this is the second part of Chapter 6. We're going to be looking at itemized deductions. So these are deductions that are from AGI, which are not as favorable as those that are for AGI. Itemized deductions are reported on Schedule A. And at the top we have medical, then taxes. The ones we're going to focus on are right here. So that's interest and charitable. Those are the two that Congress is likely to keep. Many of the others Congress may do away with. This is Schedule A for President Obama and his wife, Michelle. You can see that, like most taxpayers, he did not incur any deductible medical expenses, and he did not have any related miscellaneous. Instead, he had charitable, interest, and taxes. Congress is likely to keep the interest and the charitable, but taxes may go away. This is reporting the average deductions for different levels of AGI. The IRS actually uses these statistics sometimes when they're computing the likelihood of auditing a return. They're comparing it to the norm for the particular taxpayer of that income. Notice that at the higher income levels, most taxpayers itemize, but at low income levels they do not. Congress is proposing that we would increase the amount of the standard deduction, which means fewer and fewer taxpayers would itemize. They would also eliminate many of the itemized deductions, making it even more difficult. Medical expenses are one that's likely to be gone. Let's not talk about it then. That was fast. What about taxes? Well, they're another one that's possibly slated for elimination. In particular, there's concern about eliminating deductions for income tax. This is possibly politically motivated, but we won't get into the politics here. In all likelihood, Congress may do away with this. This illustrates the tax benefit rule, which is an interesting rule and does not always apply just in the case with taxes. But if we're not going to discuss taxes, we probably don't need to discuss it here. Whether Congress keeps any deduction for taxes is highly questionable. So in the interest of time, let's move straight to the more important aspects of this chapter, which is interest. Interest deductions are highly questionable, and again, there's pros and cons to why we allow interest deductions. But we have historically. Over time, Congress has recognized that interest on credit cards is probably not a good thing, and that to encourage savings, Congress probably needs to take action that makes it a little bit more expensive to borrow on your credit cards. That means that interest incurred on a credit card is never deductible, nor is any type of personal interest. So again, the idea is to encourage savings, which Americans are not good at. So no deduction for any type of personal interest. Nonetheless, there are certain types of things that can be deductible. Interest on your business. If you go out to finance your business and you need to get a loan in order to buy a truck for your business, then that interest would be deductible. Likewise, we're going to see interest on your home is deductible in most instances, and then investment-related interest. You're borrowing to finance your investments. Student loans we've already discussed briefly, and then we will probably pass these over to, these are quite specific with respect to the interest deduction. So passive activities we haven't discussed, and we'll only do that when we get to Chapter 7. And we'll never really talk about estate tax liabilities. So what about interest in general? Again, as I said, if it's related to your business, then it's going to be deductible in full. If it's related to your job, then it's not going to be deductible. Qualified resident interest is an important deduction to most taxpayers, and that's because many taxpayers who itemize own homes. So here we're actually looking at the interest and how much can be deducted on your home. And it's not just one home. It's actually two homes. You can have a primary and a secondary home. The amount that is deductible is based on the amount of the debt. And there's a limit on how much debt the taxpayer is allowed to have. With respect to the first rule, which was acquisition indebtedness, the taxpayer can borrow up to $1 million, and the interest on that would be deductible. In addition, there's also $100,000 of debt that would be allowed under the home equity rules. Home equity debt arises when you've been in the house for many years and you borrow from the bank based on the equity in the home. Whereas acquisition indebtedness is you're buying the house and it's new to you, or you're building or improving your own home. IRS said that this is kind of confusing, these rules, and it's particularly difficult for them to administer. So they have simplified the rules and basically said, we're just going to look at the sum total of the amount of the debt, and if it's up to 1.1 million, that's okay. The interest on that is deductible. If it exceeds that amount, then the excess is not deductible. So for instance, if we have a taxpayer who has $1.5 million of debt, and let's just say the interest on that was $75,000, how much of that would be deductible? Well, essentially we would do the proration, and we would have the first $1.1 million of that debt, which would be allowed, and that would be $55,000. Check my math, which means only $20,000 would be disallowed. This is illustrating what's required in order to have a home. Remember, since we're allowed two homes, the second one might not always be a traditional home. In fact, the first one doesn't have to be a traditional home. The requirements would be that any structure that qualifies as a home has to have a sleeping space, someplace for the restroom, and also someplace to cook. This would mean that such things as boats, certain boats, and also RVs could qualify as a second home, or even a first. What about investment interest expense? Now the taxpayer has decided they've got a portfolio, and they'd like to use leverage to increase the return. If you're a finance major, this is probably near and dear to your heart. The interest here is deductible, but it has some special rules. We're going to look at that in Chapter 7 because we're concerned about how much income the taxpayer is earning from that investment leverage, and that will factor into the calculation. So then what about classification? It's quite likely that a taxpayer borrows and maybe doesn't always use all of the funds for the intended purpose. And so we do have to do some tracing rules to try to make sure that we're deducting the correct amount of interest. This is actually quite complex in reality, and I'm not sure it's often done correctly, but we're going to talk about it then from more of a theoretical perspective, recognizing that tracing is important, and tax professionals do attempt to do as accurate a tracing job as possible. So since classification matters, and we know that personal interest is not deductible, but the business interest is, we're going to use that distinction in terms of illustrating the tracing rules. Also, in terms of refinancing, if you have an existing debt and you go out and refinance it, we're going to assume it's for the same purpose. The purpose is the same. To the extent that someone borrows money and they directly deposit it in their account and they don't spend it, we're going to treat it as investment interest expense. Again, that's deductible, but with some special rules. We won't illustrate them here. And to the extent that the proceeds are received in cash and they're not deposited, then we're going to classify it used for personal purposes. there's a special 30-day rule, and we're going to illustrate that as well. So the tracing rules come into place when there's been some commingling. In other words, someone went out and they got a loan from the bank, and they may use some of it to purchase some business equipment, and they use some of it to pay off a credit card debt or something like that. Maybe they bought a TV, who knows. The point is, they've used a loan with two different purposes, but they're paying interest just on that loan. So the interest actually arises for two different purposes, one of which is deductible and the other is not. Tracing rules or that commingling aspect come into play, and that's what we'll illustrate in just a few slides. Now, there's also a special rule that Congress allows with respect to this commingling, because they recognize that taxpayers don't always get a loan and then go out and use it for the intended purpose right away. Maybe over time, they have a series of things they buy. The 30-day rule allows us to take those expenses or those items that are purchased within the first 30 days with those loan proceeds and to reorganize them in a way that might be more favorable. For instance, if item 3 was a business debt, was a business purchase, then we might prefer to move it up to number 1 as we do our tracing rules. Again, we'll illustrate that. This is just in terms of the rules about repayments, and we're going to assume we always repay stuff that's not deductible first. That makes sense. Most taxpayers would do that if they actually thought about it. So anything that was interest that was incurred with respect to personal expenditure will be repaid first, and we'll hang on to the stuff that's going to allow us to deduct interest. Let's look at this example. B is a self-employed graphic artist who borrows $6,000 at 5% annual interest on April 13th, and he intends when he goes to the bank that he's going to use this for business equipment. So his intent in getting the loan is for business, and we know that interest for business would be deductible. The funds are credited into his checking account, and then on April 15th, he realizes that he owes some additional tax with his return. So he gets a $6,000 loan, and the very first thing he does is he spends $4,000 for personal expense, his taxes. So that wasn't really that smart, because then if we were just to follow the order, we'd say the remaining $2,000 must have been then used to buy the business equipment. When in fact, he actually spent $5,004 for the business equipment. Then we're told at the end of the year, the 19th of December, he's going to repay $3,000 of the loan. Let's see again what happens to him. First, he's not going to elect the 30-day rule, so we can't use that if he doesn't make the election. We know that the $6,000 loan, first of all, went for $4,000 of his taxes. That was considered personal expense. It was a 5% loan, and it was outstanding for 250 days of the year. Why was it outstanding not for the entire year? Well, remember, on the 19th of December, he goes into the bank, $6,000 loan. He repays half. He repays $3,000, which means that he has $3,000 that's outstanding from the 20th to the end of the year. How does that commingling affect us here? Well, let's actually take a closer look. He originally had $6,000 that he borrowed. $4,000 was for personal. $2,000 was for business. Remember, even though he spent $5,004 for the business equipment, the amount of the loan was only $6,000, and if we don't use a reordering, if we just take the expenses in the natural order they occurred, then $4,000 had to come out first, which only left $2,000 for business. Then on the December 19th date, he goes in and he pays $3,000 back. Well, we're going to assume he's smart and that he pays the part of the personal debt first. So he's going to put that $3,000 against that, which leaves him with $1,000 on the 20th of December until the end of the year. Whereas the business is outstanding for the entire year. So it goes from April 13th, the date of the loan, through the end of the year. So how does that then affect these calculations? Well, it was a 5% loan. $4,000 we said was the first amount, was personal. It was outstanding up until the 19th. That would be the 250 days. So he has interest of $137. Then when he repaid the loan, he had the $4,000 loan. He repays $3,000. He then has only $1,000 left. Again, for a few days, only $2 of interest. Total interest, $139. Not deductible because it's personal interest. On the other hand, the $2,000 business debt would be deductible. What if instead now he elects to use the 30-day rule, which in this case is going to be much better for him? He has a $6,000 debt, and we're going to say, well, he spent $5,004 of that for his business equipment. And that means that only $600 was spent for his taxes. The rest of the money for his taxes must have come from other funds. That works out much, much better for him. Now notice on this slide it's a little confusing because I have flipped it and I've moved the business up here. You're probably expecting to see it down at the bottom, but it's up there. So he has the $5,004, that's business, 5% interest outstanding. Well, wait a minute, before the business debt was outstanding for the entire year. Why is part of it now being repaid on December 19th? $6,000. He had $5,004, that was business. He now goes back in and he repays $3. What does he deem to repay first? Well, he repays the personal first, as before. Remember, he did that before. But he only has $600 of personal. That means that $2,400 has to be repaid against the business debt, which means then that the full debt after the 19th of December is business. The full $3,000 that remains now is business. So we have 250 days again, then the remaining debt, $3,000 for the remaining days of the year. So he has $190 of interest expense. And this is deductible because it's for business. Down here we have the personal debt, only $600. On the 19th he repaid it, it was gone. So it's only $21, but not deductible. When do we get to deduct interest? Well, first of all, it has to be bona fide. You have to have a real debt. And so there are special rules about related parties. We won't discuss those now. But it must be a bona fide debt, a true obligation to repay. And then if you're on a cash basis, you would deduct interest as you actually make payments. If you're accrual, it's deducted as it accrues. And I think that's what this is getting at as well. Cash basis, you deduct it when it's actually incurred and paid. Prepaid would not be deductible until it's incurred. So if it's December and someone decides they're going to prepay interest for the month of January because they think they'll get a deduction, well, you really are not allowed for a deduction on prepayments. So it's still the only deductible in 2018, even though it had been paid earlier. We won't get into discounts. What about installment notes? Again, installments, we recall from our imputed interest rules that tax law mandates that you have interest on things, right? If you're lending to an unrelated or related party, you have to have interest. And if there's not interest, it will be imputed. So if you have some sort of installment that doesn't state interest in the contract, we're going to go ahead and we will impute it. We're not going to deal with imputed interest here per se. We've already dealt with the rules, the basic rules before. This question actually just this problem at the end of the chapter just captures some basic concepts. So Randy paid some interest expense, $28,000, and you can see it was to borrow against his home or to buy a house. He also paid $2,005 on a car loan, and he had $4,002 of margin interest, so that was on his investments. So he had $28,000 for his home. He had $2,005 on a car loan, and he had $4,002 for some investments. We're asked how much can he deduct in the following circumstances. First of all, he receives $2,200 of interest income. How much could he deduct now? Well, he's going to be allowed the home interest under any circumstance. So the $28,000 he'll be always allowed. The car loan, he'll never be allowed a deduction on that. And so what this is really getting at is the treatment of the investment interest expense. The general rule on investment interest expense is you can deduct interest to the extent of the income. So he had an interest expense for his investments of $2,004, and he only had $2,002 of interest income. So he'd only be allowed to deduct $2,002 on that. Plus he'd get the $28,000 from the house. I think that's what it says here. And I wrote all over it, so I apologize. Now he has no investment income. Well, now the only thing he has is the home loan. And that concludes this second part. Thanks for listening.